Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about uranium companies. I'll give you my opinion. I was scrolling through the comments section. Someone wanted me to give some opinions on some of the uranium companies. I'm going to look at it from a little bit different approach this time, kind of describe the situation of the uranium fundamentals, some of the differences between the last bull market and this bull market, and the potential for investment and what companies could potentially do very well in this next bull market, and the reasons why I think these companies could potentially do well. So what I've got behind me, again, guys, this is just my financial opinion. Please don't use it as advice. Do your own research. Make sure these companies are right for you if you decide to invest in them. So I'll dive in here. I've got the uranium supply demand to 2035. What's cool here is you look at the supply-demand balance of last bull market. It's this deficit back here of about 40 million pounds. And this bull market here, I think, was very liquidity-driven. It was how money flowed around. We had an increasing interest rate environment from 2004 onward. We had a commodity bull market. We had an expansionary phase of real estate, etc., etc. Now, if this was the last bull market that caused the run-up in prices, look what's coming on the right-hand side for the deficits coming from 2020 onward out to 2035. These deficits are much, much larger, and they last a lot longer. There's a big opportunity because of the window of opportunity here. This window was very narrow, very small, and I think the fundamentals, the market balance, wasn't nearly as favorable for uranium to go up. This window and market balance, which also aligns very well with the expansion phase of real estate, a liquidity cycle, we'll call it, is aligned very well for a big boom in uranium and just energy in general. The energy crisis in natural gas and oil and the costs over there also lend itself for nuclear being a cheap substitute to expensive natural gas if we see an energy crisis and a shortage of natural gas like we've seen in Europe and in Asia. So this is the market balance. It was a small one back here, and this is what's coming in front of us. It's a very large imbalance. This is looking at it from a little bit different perspective. This is the world needs new uranium mines. This is the depletion of in-ground production inventory. This is what they call it, kind of the little bit of a deficit, a depletion phase 1, 2, 3, and 4 is what they have it, with an increasing amount of uranium that needs to come and be pulled out of the ground from new uranium mines. What this means is that the window of opportunity for uranium companies to come into production, I think, is greater than the last window. The last window was very small, and it didn't allow the window of opportunity for investment and a company to be successful to come online into production in that small little window was very difficult. One company did do it. They went from exploration to production. It was Paladin Energy, and that's where your massive return came from. So what I'm showing you here is that the window of opportunity in uranium, with the world needing new uranium mines and the amount of uranium that's needed in the time frame that could happen with the liquidity coming from the expansion phase of real estate, is a pretty good window. And the way that I view all of this, and we can look at this from another view here. This is uranium supply demand. This is your deficit all through here is the unspecified supply. Is if we can catch an investment where we've got the liquidity coming from the housing real estate market, and they're transferred from either exploration or development into a producer, all of that value will be transferred to their shareholders. A whole bunch of value. And you've also got the liquidity coming in. And that liquidity is going to choose more likely a company that is progressing from a explorer developer into a producer. So if you can catch that type of company, I think one could make very outsized returns. And I think that's where we would want to focus our efforts, and perhaps, one would focus their investments there with the highest probabilities of potential of successful completion of a development of a mine into a production mine. And the reason I say that, and why I would focus on that, is it's called the Lasagne Curve. And of course, let me pull up the Lasagne Curve here really quick for you guys. I had it up. The Lasagne Curve is this guy. And the Lasagne Curve looks like this. This is your pre-discovery, discovery phase. Then they go through a feasibility. It usually comes back down, and then they go into development and startup. That's the big value that is being created for the shareholders. So your timeline is here. Your value will move like this into an operating mine. What we want to identify is we want to identify companies that are at the feasibility development stage down here that can add value to the shareholders as it goes into a startup. This value can be seen in the enterprise value or market cap in relationship to the pounds in the ground. So that is what we want to look at. We want to look at the valuation and where we are on this Lasagne curve. And where I'm kind of focusing a lot of my efforts is the feasibility development stage down here, where we can get a company, and maybe I've got a couple in here as well. And with the window of opportunity being a lot larger, there's more companies that can get into the development stage and be successful at valuing their pounds higher as a producer. And when we look, and I'm going to touch on a couple of different things here too. We also have the cost curves. The cost curves at $45 put you out like somewhere in this range here. At this point here, we are still below a lot of the really high cost producers. So I think that the majority, if we're going to produce a lot more uranium and we need a lot more new mines, the price has to go higher to turn on more production from the world. So we are still below a lot of we're below the high cost producers on the cost curve. And that's what we're looking at here. We also know that uranium historically is priced quite well in relationship to history. And when the liquidity starts to come in with increasing interest rates, it usually drives the price of uranium quite higher, which will drive our uranium mining companies, the value that they have in the ground, higher, and be a very good investment opportunity. So when looking at this stuff, I've got my Excel spreadsheet here. I've got our dollars per pound. So this is the name, the ticker symbol, the market cap, the pounds in the ground, and then your dollars per pound. These are, we'll call it, this got messed up here. This is supposed to be 1850. This is our producers, either producers or developers at the top here. This Camco's a producer. They're pricing their dollars in the ground at $17.4 per pound. That is on more of the expensive side. And then you're paying $7 for Next Gen, Paladin 5.8, Energy Fuels about $9, and so forth. Denison Mines is at $7. What I focused on and where I put my money are on the ones that could potentially produce during this cycle and are priced like a developer. They're not priced like a producer. So what can happen is that the developer can become a producer and their valuation of the stock will be valued more highly. I think Global Atomic is an excellent bet for that. We've got $2.74 per poundish, somewhere in that range. And hopefully these pounds in the ground are right. It is a little bit old. But this should get valued upward, more like perhaps a Paladin Energy or higher. So we could go to $5 or $6, which is a double on the dollars per pound based off the valuation going from a developer to a producer, and not on the speculation of the uranium price going up. We also see that fission uranium is another one that could easily find more pounds in the ground. I know they're still doing some exploration and trying to better define their deposit. They're also pretty well priced, especially in relationship to NextGen. So if they can double this deposit, maybe up to around 200 million pounds or more, we could see value being added to the shareholders quite well with fission uranium. And I know that one's kind of been out of favor. I think I'm going to buy a little bit more of possibly these two companies based off the valuation and their potential ability to go into production during this cycle. So those are two that are on my radar. Some of the other ones, like Boss Energy, is kind of priced, it's a little pricey for what it is, 8.12. UR Energy, and that's probably pretty fairly priced in relationship to everything else. So you're getting the valuation of uranium going up. I think I do like Encore Energy. It's at $1.80. I do think that one is, no, it's $3.89. $3.89 for Encore Energy. $1.80 is Deep Yellow. I think Deep Yellow is a good bet. UEXCF, that's kind of a long shot play. I don't know if they're going to be able to go into production this cycle. We'll see. They are attractively priced. I do have a little bit of money in there that I'm just letting it ride through. It's not one of my bigger positions. I do have Forces Metals as well. It's $1.07. So I've got some money in that, and I do have Deep Yellow, John Borshoff, and hopefully he can pull through. But I know they're also looking at possibly proving more pounds in the ground than what they've got proven up so far. So they're also working on that aspect to add shareholder value. Bannerman's another one I really do like. I think Brandon Monroe, if he can pull this thing off, this is a position I overweighted. I overweighted Encore Energy, Deep Yellow, Forces, and Bannerman, and Goviax. Notice that they're all very cheaply priced. Again, they're going to have to prove up reserves. They're going to have to develop their projects, and hopefully they are successful at adding shareholder value and getting closer to production over this cycle. Hopefully. So those are ones that I kind of own. I own a little bit in Laramide, 2.25. I own a little bit there. I own Appia Energy, Forum Energy Metals. Some of these explorers I own as well. Other ones that can go into production this cycle, obviously Camco, they're going to have some stuff that's going into production. NextGen, they might be able to do it. Paladin definitely will. UU, they probably can. Denison Mines probably can. UEC, I bet you they probably can. URG probably can. Boss Energy can. So they're all getting priced like they can go into production. So the opportunity is the ones that are priced low that could potentially go into production. So I've got Global Atomic, Fission, Encore Energy, Deep Yellow, Forces, Bannerman, Goviax. So those are the ones that I'm betting on. So right, wrong, indifferent, those are the ones that I see the value in. Those are the ones that are in a little bit easier jurisdictions to possibly get this thing rolling. And I'm spread across kind of all those that I just talked about there. I do have smaller positions in, like in a UEC, something like that, or a Denison Mines. They're bigger companies, and they're more fully valued. They've got richer valuations. So I'm going after the ones that are lower in the valuations per pounds in ground. I know that some of their assets aren't, they're not as high of uranium concentration, but they seem to have the bounce in the charts. So I also look at charts. I also look at fractals. I think that some of these, I'll call it the African crew. That's what I call it. The African crew might do pretty well. The African crew compiles, or composes of a Paladin Energy, Global Atomic. We've got Deep Yellow, Forces Metals, Bannerman, and Goviax. That's the African crew. There might be one more that I'm forgetting. That also has assets over in Africa. Everyone else, I think Fission Uranium could be a good bet, especially if they can prove up that they've got more in that deposit than 135 million pounds. That's adding value to the shareholders. And if they can go into production. And another way to value some of this stuff, I mean, you can ask yourself questions like, is it traded on a major exchange where Robinhood investors can have access to get investments to it? If the answer is yes, then something like a Denison Mines or a UUUU, UEC, those are the type of companies that I think people will pile into. So you could obviously make a very easy argument of why to buy those. Now, someone else can make the argument, which I just did, based off of the valuation of pounds in the ground and where it is on the Lasagne Curve, and where value could be added to shareholders and it could move up. The African crew, which is mainly OTC stocks, could be one that people like. OTC being over the counter. They're pink sheet type companies. They're not traded on major exchanges. So one can make the argument that they're the best valued of the group, and that investment should go into those. And then there could be other ways that you could validate or talk about why we should go into Camco. That they're already in production, they've got more dollars, they've got large assets, Cigar Lake and whatnot, MacArthur River and all these other ones where, potentially they could go back into production, increase production, expand those resources where it's a lower risk, bet. And what really happens is you get into this like circle where all of the companies that have survived over the bear market, you could argue that any of them are pretty much good. So I've overweighted the African ones. I've overweighted some of the Canadian ones that have good deposits. Next Gen Energy and Fission were the two that I like. Am I going to be right? Tough to say. Some people think that Denison Mines has the best technical team. That might be the best investment. It very well could. They do have a larger market cap, and you are paying a little bit more on a dollars per pound for it. So the market agrees with that type of analysis. So I like all of them. So you're probably not going to lose with going with any of these ones that survived the bear market, that are developers. Money's going to probably flow into all of them over this big bull market. And I think that the opportunity for this next bull market where these guys come in and can produce, go from a developer to a producer, is a higher likelihood this bull market. So I think spreading amongst the ones with high probabilities is probably a good bet. Something like a Next Gen Energy, which will develop, that's kind of, it's going to take some work. Roads and all these other things going to the deposit may need to be developed. But something like a UUUU probably could do it. Paladin's definitely going to probably do it. Denison Mines probably is going to go into production. UEC probably is going to go into production. URG is probably a good bet. Boss Energy is a good bet. Encore Energy probably could do it. Deep Yellow, we'll see. UEXCF, that's kind of your long shot, I think. Forces is a long shot. Bannerman might be able to do it if Brandon can pull that off. Those are the ones that I think could potentially go into production, and I think any of them are probably good bets. So, give me a thumbs up for the content, guys. Subscribe to the channel if you haven't already. Hopefully this helps you out a little bit on furthering your research on what you want to look at. But that's my opinion on it. And hopefully some of these guys go into production, because if they go into production from being a developer, that's going to add a lot of value to their shareholders. And if we get a really large uranium bull market, it's going to be very good for shareholders. So hopefully it pans out well, guys. Thanks for listening. This is Finding Value.